A very good evening and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now, we've just heard the news last week that the local Reserve Bank increased interest rates by 50 basis points or 0.5%. But what does this mean for you who might be a saver and if you have debt? Well, to tell us more, I'm joined by Niels du Toit, who's a certified financial planner at Discovery. Thank you so much for your time today, Niels, and thank you for joining us today. Perhaps let's pick up on the interest rate decision. 50 basis points, shock, horror. Should we be reading it with that kind of reaction in mind?
Yes, thanks, Gugu. I think we did expect it. I think it came down to, was it going to be 25 basis points or 50? I think we're also in a position now where we probably can expect some more increases in the future.
Ooh, that's not what we want to hear.
Unfortunately, yes. I think inflation is under a lot of pressure, as well as the rand depreciating a little bit further, although it did recover after the decision. But I think it's uncertain times, which will take a lot of planning from the client's point of view.
Exactly. So let's put myself in this situation then. I have a bond. I got a nice email from my financial services provider who told me, hey, interest rates have gone up. This means your bond payment will also go up. Should I be restructuring my expenses or budget in any way?
Absolutely. I think it's a straightforward thing that you will all of a sudden start paying more now on the bond. Anything that's credit related from a credit account point of view. You're talking about personal loans, you're talking about credit cards. Remember, we still need to drive our fancy vehicles.
Tell me about it.
So unfortunately, I think if you just take an average bond of 1 million rand, it will probably cost you almost $400 extra additional a month, which means that you will need to go back to the budget if you do have one, which is probably a big problem overall in South Africa. People don't budget, and then restructure it in a way to say all of a sudden where can we now cut a little bit of cost to move forward and have the self-discipline to stick to the budget as well.
Which obviously brings in the all-important question of what should I be asking my financial advisor, which is what we constantly advocate for here on the show. Instead of going it alone, seeking professionals like yourself. What kind of questions or questions are your clients asking you, and what kind of advice are you offering with regard to reviewing one's budget? Are there easy items that can go off on anyone's budget?
Yes, I think what's most important is to sit down with a qualified person and to say, listen, this is my budget. I've got these type of expenses per month. Identify which ones are the fixed expenses that you can't get away with. But then there's also stuff that you can adjust probably on a month-to-month basis. I mean, just take, for instance, your short-term insurance. You can probably just review that and play the competitiveness in the market a bit. And, through driving behavior from a Discovery point of view, it gets some fuel back per month. So that's vital points that you can actually take to the qualified persons and get help with that. So don't take drastic decisions by yourself. Don't cancel stuff just because you think that's the most expensive or the one that you can get rid of for the next few months, because it's also a decision that you can take now that can actually have consequences later on, like cancelling a medical aid or short-term insurance or even life insurance.
But what about those individuals who are highly indebted, have store accounts, have school fees to pay, personal loans, student loans, have a bond, vehicle financing? Is this the opportune time for them maybe to consolidate their debt, maybe fix their interest rates? Are these potential questions and themes that they need to start exploring?
Look, I think for those type of profile, the clients need to realize that this is reality. First of all, face it. As I said, there could be potential increases in the rates moving forward. So if you want to go and consider a fixed rate, it's maybe a good thing, because sitting in the position, knowing what to expect each month, you're probably going to make a short-term decision that's going to gain a little bit more benefit in the future. So as I say, it comes down to self-discipline, saying, listen, this is my budget, writing it down actually and seeing it in front of you, because then it's a plan that you work towards. And then realizing that, look, if I need to consolidate, I need to go and approach people in the market, which the institutions are there, and then basically take it from there and sticking to that plan and moving it on and facing it hurdle by hurdle as you go along.
What about the individuals who might be savers, who are getting it right, who are on track and have sufficient funding with regard to their short-term, medium-term and even long-term savings objectives? Interest rate increases are a good thing, right?
Yeah, I think there's specific clients that always will phone you first to say, listen, what's happening with my portfolio from an investment point of view? We all know that the rates within the banking environment do go up as well. I think which is good from a savings point of view. There's certain stuff still to have a look at, to say, listen, interest rates have increased, so that means my return will probably be slightly higher, but am I going over an interest exemption that's in the market, which is very critical. You don't want to pay too much tax at the end of the day, which also means that you can actually restructure an investment portfolio in such a way to say, listen, I've got short-term money within a money market account or something like that. And then basically saying, but there is opportunity on the side to maybe have a little bit of diversity, have a little bit of global exposure, those type of things.
So would you be getting into the markets at these levels, or like you say, it depends on the client, their risk appetite?
Yes, definitely. I think needs, risk appetite, and then also in terms of experience, what the clients would like to have. Having a needs analysis done to say, listen, if you've got a term of at least 5 to 10 years, it's maybe a good thing to have a look at an offshore exposure now. There's certain funds that's doing extremely well. Of course, there is risk related to mostly to that type of funds. And then to say, all right, stick to my plan and think about where I want to be within a year or two or even 5 years from now, and sticking to that goal and moving forward.
I'm going to take advantage of the fact that you're a certified financial planner and throw this into the mix. The recent movements we've seen for individuals who are close to retirement. It's the retirement reforms, it's the market volatility. For them, they're probably sitting in quite a nervous position right now because they're hoping that the negative market sentiment won't impact on their investment returns within the short term and also the retirement reforms. But all in all, I understand things aren't too negative for them, right?
Yeah, I think in any case, when you're approaching retirement, you in any case need to be conservatively exposed. You can't actually, unless you're a very high risk taker or so on, but you need to be conservative.
Or if you've got, 40 odd more years to live, right?
Absolutely. Then you can just, forget about it. But for the guys approaching retirement within the next year, even to 3, it's going to be tough out there in the market. Returns, we're not going to be as spoiled as in the past. So rather be conservative, grab your returns of just beating inflation plus 2 to 3%.
Yeah.
I think then you're doing well. At least then you're protecting as from a retirement side as well. And then also approaching and getting into retirement, there's some good portfolios out there and making sure that at least the return will be sustainable for the income that you draw.
Versus someone in their 20s and 30s who can ride out the market volatility over the next, 20, 25 years, get into the market potentially now.
Absolutely. From a retirement point of view, there's regulation 28, so you need to be compliant in terms on the fund choice there, but be as aggressive as possible moving forward within the markets if you're young. It happened in the past, so for the guys that has got term, just ride the wave and it will recover. And as I say, just review fund choices. There is still a lot of opportunity out there to get decent returns.
I understand the timing of this year also is quite poignant given the fact that we're in the month of February and the tax year comes to an end at the end of Feb, which does allow for a voluntary additional payment, if I'm not mistaken, when it comes to retirement funds. Tell us a little bit more about that, Fee.
Yeah, absolutely. If you've got space from a tax benefit point of view in terms of the current tax legislation on retirement funds, you can add additional lump sums to your retirement portfolios.
How large are the lump sums?
It's based on 15% on your pensionable salary, as well as then up to limits. Of course, that is going to probably change quite a bit now with the new retirement reform, which is also great. I mean, people need to see that as an opportunity. We've got one of the worst savings rates in the world, and that we know. So hopefully that will motivate the people and to build a retirement portfolio that at least you can, not be part of the statistics, not being able to retire one day.
Exactly. Well, we don't want the viewers to go home with a sour taste in their mouth. So fundamentally, there are positives to draw out from the macroeconomic situation. So interest rates, like you say, settle your debt and find opportunities to save and perhaps get into the market, like you say.
Yeah, absolutely. I think first point is basically accept it. It's here. So make the best of it if you can. It does sound strange saying that, but have your budget set up, stick to it, don't go off it. Don't buy something because you want it. If you don't need it, rather stay away for now. Save for a specific item rather than going out and issuing some further debt on your name. And then of course, review short-term insurance, review your strategy moving forward. and writing a plan down, and then of course sticking to the goal when it comes to the investments.
Exactly.
That's probably the best for now.
Well, we've certainly said a lot with regard to the current macroeconomic outlook and what it means for your back pocket. But Niels, just to get your closing view again as well with regard to how consumers need to take advantage not only of retirement savings, like you said, interest rates, which you've already alluded to, but also the market volatility. I take it, number one, pencil in that date for your meeting with your financial planner, right?
Absolutely. And I think also very important with that is take your Mrs. or Mr. with you. You know, the spouse is a vital part of the role. I think there's a lot of communication missing between husband and wife, maybe sometimes. So have a plan, go towards the qualified persons, let them assist you with reviewing your budget. And as I say, write it down, force yourself to see that every month. And then basically starting at a point and working through it so that you can actually get relief in the medium to long term. It won't be there immediately, so don't stress and lie awake at night. Rather, have a look at the budget, follow it through and stick to your guns, and the relief will come.
Exactly. And here I thought it was enough that I take my husband's credit card to buy my shoes, but clearly that needs to change.
Absolutely, and that's where the communication comes in.
Niels, thank you so much for your time today. Much, much appreciated. Well, there you have it, invigorating conversation with regard to the interest rate cycle we're in, how to optimize on your retirement savings and the potential additional outcomes that you can add into those savings there. But a big thank you to our guest this evening, Niels du Toit, who's a certified financial planner at Discovery, for joining us this evening. You too can be part of the conversation, so get tweeting at CNBC Africa using the hashtag Finance410, or alternatively tweet myself at Gugulethu. Until next time though, it's goodbye for now.